When will Apple finally get its due? I'm not talking about this meager $4 rally today in response to what I thought was a real good quarter. I would have said the same thing when the stock was up 8 before Fed Chairman Powell cut the Fed funds rate and then cut the legs off the market, although I don't think he really meant to. Now, when I say Apple and extension, of course, CEO Tim Cook haven't gotten their fair share of praise. I mean, when will the analysts stop worrying about the slowing of the cell phone business and start focusing on the far more vibrant service revenue stream in a way that makes sense to me? People just don't understand how to evaluate the new Apple. They view it as a sagging hardware story. Just listen to these headlines from the digital edition of the New York Times. Quote, Apple reports declining profits and stagnant growth again, end quote, which I guess is better than the newsprint edition's header, which just said declining profits again in Apple's latest quarter, end quote. Then the Wall Street Journal weighs in with quoting an analyst, Richard Cramer, blessedly no relation. Asked about Apple's relationship with the Chinese, he says, quote, it's not a matter of if, but when Apple gets hit in China, end quote. And, the problem with these two stories, how about the fact that Apple's China business actually accelerated this quarter? How about the fact that their software ecosystem got stronger and stronger as the quarter proceeded? There's a VAT tax cut and there was some trade-in stuff, but hey, it was better. Here's what you need to understand. iPhones now account for less than half of Apple's sales. You can't be so myopically focused on cell phones that you ignore the more important service revenue stream. That's the stream of the future. It's a stream that's growing at an 18% clip when you back out a one-time item and 300 basis points of currency. Yeah, the dollar's too strong. Once again, we see that the strong dollar is hurting every American company that's in this export business, although that wasn't enough to stop Apple. When you throw in the wearables division, Apple's a juggernaut. There's tremendous growth in Apple Care, Apple Music, Apple Cloud Services, the App Store, and the ads in the App Store. I don't know about you, but every single one of those click, click, click from me. People keep underestimating Apple's new business model. Wearables clock in at a near 50% growth, in heaven's sake. They're wiping out the watch business. Companies still can't meet demand for the AirPods. That's actually bad now. I'm tired of that. Between the wearables and the service stream, they racked up $17 billion in sales this quarter. The phones, $26 billion. But when you throw in the iPad and the Mac, both of which, by the way, had amazing growth, the non-iPhone businesses generated $27.8 billion in sales. Given how much faster those businesses are growing, you can expect them to become a larger and larger part of the mix, the dominant part within a few years. So why don't the analysts get it? Why did price targets barely budge? Why didn't anyone upgrade from a hold? There's a lot of holds out there. I got a theory. My theory is that these analysts are the same gang that covers the FAANG stocks, Facebook, Amazon, Netflix, and Alphabet. Within FAANG, Apple is the slowest grower, by far. If the iPhone grows at a 1% clip year over year, well, that's a severe disappointment for these people. As for the service revenue stream, I think they're a loss. I don't think they know how to value it. My solution, you need to view every hardware sale as almost like a one-time game. Hardware is inherently cyclical, but the subscription business, that's more like a cable company. Get a cable analyst to follow with a tech analyst. Hey, think about a cable company. It hits you up for more money every month, except Apple's customers have a roughly 99% satisfaction rate. They ain't going anywhere. Right now, Apple does these analysts no favors by saying that there are 420 million paid subscriptions. We don't want that. We want to know how many subscribers, not subscriptions. How many? We need that. We need to know the take rate so we can build models. What's the churn? If the churn is low, you can figure out the lifetime value of a subscription. I know this business because in my spare time, I started a subscription business at TheStreet.com. It's a terrific annuity if you have low churn. Here's the issue, though. A tech analyst who covers hardware or software companies won't understand any of this. They might not recognize the lifetime value of a credit card holder. You can do that stream at let's say, how about Bank of America? If you have about 1.4 billion people owning an Apple device and you know the take rate and the churn, I think you'd see a terrific recurring revenue stream here that you could put a price earnings multiple on. The kind of thing that a cable analyst would totally get. Or it could be covered by a consumer products analyst, a Procter analyst, who would view the handset as a razor and the services as a high-margin razor blade. Until Apple gets this kind of dual coverage, I think the stock will remain ridiculously cheap. What a firm could do this and really just plant a flag here. But give it to an entertainment analyst or a consumer packaged goods analyst, and I'm betting the stock would catch fire. I don't know how high it would go. I could, on the back of the envelope, easily get to $260. But take it from someone who knows the subscription biz. I know Apple's stock price will be a heck of a lot higher than it is right now. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.